Many traders continue to watch moves in the bond market to see if they are signaling a recession this year. Christopher Vecchio is a senior strategist at dailyfx.com and joins us now. Chris, always great to see you. Should the market be more concerned by these moves in the bond market here, potentially signaling a recession? By and large this week, it has been surprising to see this market resilience.
Good to see you again, Brian. Yeah, the bond market's been on fire recently. Yields have been jumping across the curve, and we've already seen some signs of inversion throughout that curve. The 3, the 5, the 7-year, that belly of the U.S. yield curve has inverted relative to the 10. We're waiting to see if that 2-10 spread moves into inversion territory as well, which is something that we expect to happen over the coming weeks. But this is an important development because typically speaking, in the post-World War II era, yield curve inversions have been correlated with being viable recession indicators about 12 months ahead of time. We actually just saw this recently at the end of 2019 when the 2-10 spread inverted, and sure enough, the pandemic arrived just a few months later. So from a trading perspective, what does this mean for us? Well, it means short-end rates are continuing to climb faster than long-end rates. This isn't a steepener that's occurring, it's a flattener, whereby the 2-year is catching up to the 10. We anticipate that to occur moving forward, and quite frankly, that means good news for the U.S. dollar. According to the Bank of International Settlements, it's the 2-year yield differentials are the main driver of spot FX rates, and as that 2-year yield climbs here in the United States, it gives the U.S. dollar a little bit more of a backbone moving forward.
We'll add another red flag to the mix, Chris. Higher U.S. dollar is not necessarily great for the earnings power of multinationals. You have higher oil prices. All these little red flags, in your view, do they set the stage for a correction in April?
I do think that we need to be on alert for a deeper setback in stocks. Right now, the table has been set for a turn higher insofar as the Fed's clarity on what they will be doing with interest rates moving forward has provided a degree of relief for investors. I think there's a sense of calm that as the Fed acts more quickly in the short term, there'll be less long-term structural damage to the economy, which allows stock prices to stay a little bit more elevated. The chance of a policy mistake has been diminished with this strong tone that Powell and Cole have unrolled over the past week, which is we're going to see 50 basis points worth of hikes when they meet again this coming May. But when we talk about the earnings picture, yes, there has been deterioration there. According to FactSet, we're looking at the slowest rate of earnings growth going back to the fourth quarter of 2020. Rising interest rates, generally not good for those long duration assets. And it looks like we're going to get a bunch of interest rate hikes here this year, perhaps maybe another 150, 200 basis points worth of hikes in calendar year 2022 alone. And so coupled with an environment where U.S. growth is beginning to sag, the Atlanta Fed GDP Now growth tracker still below 1.5% for the first quarter. It's not really that appealing of a mix. So what I see here over the past week or so, this is a relief rally in stocks, a lot of short covering going on, not necessarily a bunch of new investors coming to the market and staking out long positions that they intend on holding for a considerable period of time.
So, Chris, it's Julie here. So, if we are still set up for a rocky road for equities, if the dollar is going to rally, I mean, besides the dollar, are there other places that investors can go right now to sort of weather some volatility coming up?
Sure. In this environment where we have commodity prices running higher and higher, seemingly every single day, I would think that looking at currencies' terms of trade is very important. Currencies where their countries export a lot of commodities have been doing quite well. Those countries that import a lot of commodities are doing poorly. A case in point for this is the Japanese yen. Japan's an economy that imports over 90% of its energy still. In the decade after the Fukushima earthquakes, we see that they had more problems recently with the new earthquake shutting down power supplies to Tokyo, and the yen has been absolutely falling apart. I would think that in this environment, pairs like CAD yen or Aussie yen remain quite appealing because you get broad commodity exposure if it's through base metals or through energy, through the Australian and Canadian dollars, whereas Japan is still in this very difficult situation. Look, as oil prices go up, Japanese businesses and consumers need to convert more of their yen into U.S. dollars in order to pay for their energy use. And that's only going to continue for the foreseeable future, where we don't really see an off-ramp for crude oil prices to take a significant turn lower right now, particularly as this Russian invasion of Ukraine presses on into its second month now.
Chris, I know you also watch closely cryptocurrencies and Bitcoin. This story that Russia might accept Bitcoin for its oil, is that the type of development that would push Bitcoin over 50,000?
It's possible. I think people should be cautious about cheering on Russia using Bitcoin as a way to circumvent U.S. sanctions, because that could bring in heavy-handed regulation, the kind that's maybe a little bit too far gone for your average crypto investor to want to stay in the space. Regulation is a good thing, though. It legitimizes the space for the long term. It makes it safer for mom and pop investors, for your retail investors to operate. It's like driving down a highway, right? If you know that there's a speed limit and guardrails, you're more inclined to use it rather than a dimly lit dark road that's not paved over. So we want regulation in the crypto space. But if the crypto space is being used and abused by bad actors, if it's Iran or North Korea or Russia now to circumvent US and EU regulations, that poses a deeper problem where American, European regulators could come in and really clamp down on the space and deter capital flows altogether. So it's a careful balancing act. This is a good rumor right now, but any significant development here, I think, needs to be looked at cautiously and carefully.
Christopher Vecchio, Senior Strategist at dailyfx.com. Always good to see you. Have a good weekend.